Welcome back to the deep dive. Today, we are tackling a subject that is, well, it's basically the Mount Everest of investing. We're talking about the absolute gold standard of global macro trading.
It really is. I mean, the term gets thrown around a lot, but this is one of the few cases where it actually fits. There are great investors, and then there's the tier this guy occupies.
We're talking, of course, about Stanley Druckenmiller. And just to set the stage, for anyone who doesn't know the stats, we're looking at a 30-year track record. 30 years of about 30% annualized returns.
Which is already incredible.
But here's the kicker, the stat that really matters. He did it without a single losing year. Not one.
Yeah, and if you know anything about probability in the markets, that borders on statistically impossible. It really makes you wonder if he's even playing the same game as everyone else.
That's exactly the feeling I got reading through this. You know, the easy answer is to just say, oh, he's a genius, or he has a gut feeling. But the source material we're unpacking, specifically Druckenmiller's daily technical charts explained, just completely blows that idea up.
It does.
This isn't magic. It's not gut. It's a very specific, very disciplined framework. And it all starts at 4:00 a.m.
It does. And that's what we're going to do in this deep dive, decode that routine. We're not just looking at his biography. We're essentially looking over his shoulder at his dashboard. We're going to break down the charts, the indicators, the mental models he uses.
And the mission here is really to bridge that gap, you know?
Yeah.
Usually you've got two camps. You're either a fundamental investor.
Right, looking at earnings, PE ratios, all that.
Or you're technical, just staring at lines on a chart. Druckenmiller seems to completely reject that split.
He sees that split as a liability. His whole philosophy is that fundamentals tell you what to buy or sell. They give you the story, but they're terrible, just awful at telling you when.
Okay, so he uses the technicals to time his fundamental ideas.
Exactly. The charts are there to confirm or deny what he thinks is happening out there in the real economy.
So let's start where he starts, 4 in the morning. Why on earth that early? Is this just that billionaire hustle thing? No, it's not for show. It's purely functional. Think about it. Global markets are completely interconnected.
Yeah.
By 4:00 a.m. here, Europe is opening up. Asia is winding down.
Okay. So he needs to see what happened overnight.
He needs to assess that overseas price action immediately. Capital flows like water. You know,
Yeah.
What happens in Tokyo impacts London, which then impacts New York.
So he's not reacting. He's anticipating, looking for where the puck is going to be.
That's the perfect way to put it. He's trying to visualize the world 18, maybe 24 months from now. He's using these early morning charts to test a thesis about the future, not just see what happened yesterday.
Okay, so he's there, coffee in hand. What's the very first thing he's looking at? This was, for me, the first big surprise in the research. He's not looking at earnings reports.
No. And this is where, according to him, most investors get it wrong right from the start. He explicitly believes that relying on earnings to predict the market is a mistake.
That sounds like heresy. I mean, we're all taught that stock prices are just the present value of future earnings. If earnings don't move the market, what on earth does?
Liquidity. It's the Federal Reserve.
Yeah.
It's the broader movement of money and credit. For Druckenmiller, liquidity, the expansion and contraction of money, is the single most important variable, period.
So his dashboard is tracking things like the Fed funds rate, central bank balance sheets.
Exactly. Money supply growth. He's tracking the fuel, not the car.
That's a great analogy. You can have a Ferrari of a company with amazing earnings, but if the Fed is sucking the liquidity out of the system...
That car is going nowhere. And conversely, if there's a flood of liquidity, even a clunker of a company can get pushed uphill for a while.
Okay, this brings us to a concept in the notes, the second derivative. Now, this sounds a little like calculus class, which might scare some people.
Right.
Can you break that down? Why does he focus on the rate of change?
It's because the market is always looking forward. It's a discounting mechanism. If you wait for the economy to actually recover, wait for GDP to turn positive, you've already missed the entire trade.
So you're looking for the turn before the turn?
You're looking for when things stop getting worse as quickly. The second derivative is about spotting when the rate of decline slows down.
Give me a concrete example.
Okay, think about a recession. Everything's getting worse. Unemployment is going up month after month, but then 1 month, unemployment goes up, but less than it did the month before.
So it's still bad, but it's getting less bad.
That's precisely. That is the inflection point. That's the second derivative turning positive. And that's often when you buy. The sources point out that markets often rally 6 to 12 months before an economic recovery is obvious in the data.
Because they're pricing in the Fed easing. That just started. And the reverse is true too, right?
Absolutely. When the economy is booming, everyone's hiring, earnings are at record highs, that's often when he's selling. Because he knows the Fed is about to tap the brakes. He sees the liquidity headwind coming before it hits the headlines.
It's a very contrarian way of thinking. You have to be willing to look stupid for a while.
Oh, for sure. Or at least feel really uncomfortable. If a trade feels comfortable, you're probably too late.
Okay, let's shift from the macro liquidity view to the actual charts. The outline calls this the primary filter, and it's a line I think a lot of people know, but maybe don't use it this way, the 200-day moving average.
Yes, this is the definitive regime filter. He treats it like a binary switch for his entire portfolio.
A switch, so it's that simple, just on or off.
In terms of his aggression, yes. If the price of an index, say the S&P 500, is above its 200-day simple moving average, the environment is offensive.
And offensive means?
It means you swing for the fences, you make those high-conviction big bets, you can use leverage, you're playing to win.
And if the price breaks below that line?
The switch flips.
Yeah.
Instantly. It becomes defense, defense, defense. Your focus shifts immediately to capital preservation. You're not trying to be a hero anymore, you're just trying not to lose money.
But what about all the noise? Markets are choppy. I mean, what if it dips below for a day and then pops right back up? You sell everything and then buy it back 24 hours later.
That's the danger, the whipsaw. So to counter that, the source material talks about a couple of nuances. First is the slope of the line. A flat 200-day average doesn't tell you much. You want to see a rising line for a bull market and a falling line for a bear.
Okay, so direction matters. And what was the other part? A confirmation rule.
Yeah, this is key. His framework suggests you wait for confirmation. A trend change is really only validated if the moving average itself starts to turn. Or you wait for the price to move, say, 0.5% to 1% beyond the line to confirm it's a real break, not just noise.
What's a filter for the static?
Exactly. And historically, this has been a lifesaver. The sources cite the 1987 crash.
Black Monday, the big one.
Right. And what's fascinating is that major corrections like that almost never happen when the market is at a 52-week high. They are almost always preceded by the price breaking below that 200-day moving average. It's the early warning system.
The canary in the coal mine.
If you respect that line, you likely won't be holding a full bag of stocks when the bottom really falls out.
Speaking of things falling apart, that leads us right into market breadth. Because an index like the S&P 500, it can lie, can't it?
It can absolutely lie. It's market cap weighted, so the biggest companies have all the influence. You can have a situation where, a few mega cap tech stocks are soaring, making the index look great, but underneath the surface, 497 other stocks are actually down.
We've definitely seen that movie before.
We have. And Druckenmiller treats that as a massive yellow light. He calls it internal rot.
That's such a vivid image. The apple looks shiny on the outside, but it's rotting from the core. How does he actually diagnose that?
He uses the advanced decline line, the AG line. It's a really simple metric. You just take the number of stocks that went up that day and subtract the number that went down, and you plot that cumulative number.
And you want that line to be moving up with the S&P 500.
Exactly. You want broad participation. You want the troops to be following the generals up the hill. The real danger signal, the flashing red light, is divergence. That's when the price index makes a new high, but the AD line makes a lower high.
Meaning the soldiers are starting to retreat while the generals are still charging ahead.
And we know how that ends. Eventually, the generals get shot. And looking back, this was the key signal before the 87 crash. The indices looked strong, but the breadth, the participation, it just wasn't there. That divergence is what told him to get bearish before the crash.
It's amazing how it's all about human psychology. These patterns just repeat. So we have the 200-day for trend, breadth for health. Now for something that sounds like a horror movie title, the 3 death nails.
It sounds dramatic, but it's accurate.
Yeah.
These are 3 specific macro indicators that, when they rise at the same time, create a perfect storm for the market.
Okay, lay them out for us. Nail number 1.
Nail number 1, rising interest rates. He's looking at the 10-year Treasury yield. When rates go up, the discount rate on future earnings goes up. It makes stocks, especially those high-growth tech stocks, mathematically less valuable.
It's like adding gravity to stock prices.
Yeah.
Got it. Nail number 2.
A strong U.S. dollar. When the DXY index trends up, it tightens financial conditions everywhere. It hurts U.S. multinationals because their foreign profits translate back into fewer dollars. But it also crushes emerging markets that have debt in dollars. It just squeezes the whole global system.
Okay, and the final nail in the coffin?
Rising crude oil prices. He just sees oil as a tax. It's a tax on every consumer at the gas pump, and it's a tax on every manufacturer through higher input costs.
So if you see rates up, the dollar up, and oil up all at once.
You run for the hills.
Yeah.
The synthesis is that when those 3 converge, the macro environment is officially hostile. It doesn't matter how good your stock picking is, the tide is going out on everyone. You just have to respect the downtrend.
I love how clear and unambiguous that is. It removes the guesswork. Now let's pivot to something a bit more granular. He also looks at specific sectors for clues, right?
Yeah, he sees the market as this living thing. He looks at the circulatory system, which for him is the transportation sector, specifically trucking stocks.
Trucking, why not tech or banks?
Because nothing gets sold in the real world if it doesn't get moved on a truck. If the charts for trucking stocks are breaking down, it's a real-time signal that the volume of goods moving through the economy is dropping. And that signal shows up way before the official GDP data comes out.
It's data from the ground floor. And he also watches housing and retail.
Housing is the most sensitive to interest rates, so it's the canary in the coal mine for Fed policy.
Mm-hmm.
If housing starts to roll over, you know the rate hikes are starting to bite. And for retail, he looks at what they call granny retail, the XRT ETF, to see if the average person is actually spending money.
Okay, now there was one industry insight in the notes that really just blew my mind. It was about the chemical industry, and it felt completely backward.
Oh yeah, this is classic Druckenmiller. He says you do not buy chemical stocks when their earnings are good.
Which is what everyone else would do. Oh, Dow had a great quarter, time to buy.
Exactly, but that's the trap. You buy chemical stocks when capacity has left the industry.
Unpack that for me. Why capacity?
Because chemicals are a commodity. When earnings are great, every company rushes to build new plants to chase those profits. But a plant takes years to build. By the time it comes online, the market is flooded with supply, prices collapse, and margins get crushed. So the announcement of new plant construction, that's a sell signal.
That is wild. You sell in the good news of expansion.
And you buy when companies are going bankrupt and shutting down plants. Because when that capacity leaves, pricing power comes back to the survivors. It's just a perfect example of looking at supply, not just current income.
This all brings us to the mental game. Because you can have all these charts and rules, but if you can't actually pull the trigger, it's all useless. The notes mention something called delta ROC.
Right, this goes back to that second derivative idea we talked about, but applied to momentum. He's measuring the acceleration or deceleration of a trend.
How is that different from just seeing the price go up?
Well, think about throwing a ball in the air. For a moment, it's still going up, but gravity is slowing it down. Its velocity is positive, but its acceleration is negative. He wants to spot that deceleration. It helps him catch the bottoms of pessimism or the peaks of euphoria.
Speaking of crowds, there's a great quote in here from his mentor, Spiros Drill. 60 million Frenchmen can't be wrong.
I love that quote. It's a metaphor for the market. Drill's taught him that the market price contains the collective intelligence of millions of participants. It's just inherently smarter than any one person.
So if you've done your homework, you love a company, but the stock is tanking.
The price is probably right, and you are wrong. It's about having a deep respect for price action. If your story conflicts with the chart, you have to assume the market knows something you don't.
Which leads to this final, maybe controversial point, stop losses. Druckenmiller apparently hates mechanical stop losses.
He calls them the dumbest concept, but it's very nuanced. He doesn't like setting a rule like, I'll sell if it drops 10%.
Yeah.
He uses what he calls thesis-based exits.
Okay, what's the difference?
The difference is intellectual honesty. If he buys a stock for a specific reason, say, a liquidity catalyst, and that catalyst disappears, or the chart breaks down in a way that invalidates the reason he bought it, he's out immediately.
Even if he's only down like 1%.
Even if he's up 1%, he exits because the reason for the trade is gone. He doesn't wait for a 10% loss to tell him he was wrong.
So you basically have to wake up every morning and re-justify every single position in your portfolio.
Every single day. He talks about being able to wipe the slate clean. You can't be married to yesterday's position. If the facts change, you change. Now.
That is incredibly demanding mentally, to admit you were wrong that quickly.
It is. It requires checking your ego at the door every morning. But that's the price you pay for 30% annualized returns.
So as we wrap this up, the sources do mention the style is getting harder, with algorithms and machine trading adding so much noise.
It has. The machines can create a lot of volatility and false signals around those same technical levels. He's admitted that the signals are a bit duller now, and that he has to mix the framework with a dose of instinct to survive.
But the core toolkit, that remains the same. Let's recap it, just as a checklist for everyone listening.
Sure. It starts with a liquidity check. Don't fight the Fed. Second, the primary filter. Use the 200-day average as your offense-defense switch. Third, check for internal rot with market breadth. And fourth, watch for the 3 death nails: rising rates, dollar, and oil.
And if those nails are hammering down, just step aside. Cash is a position.
It's offer the best position.
So here's a thought we want to leave you with. It goes back to that 60 million Frenchmen idea. If the market is smarter than you, take a hard look at your portfolio right now. Are you holding on to anything just because you think you know something, while the price action is screaming that you're wrong?
That is the uncomfortable question, isn't it?
It is. but asking it might just save your portfolio. And speaking of keeping track of these big signals, we actually have a tool that can help.
That's right. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from the Apple App Store.
EOAE, Babel Store Posha, AWO Buffett Indicator. Okay. And if you found this deep dive valuable and you want to get access to more advanced content, you can always join the Deep Value Club membership.
And don't forget to follow us on your favorite podcast platform.
All right, disclaimer time. All the analysis here is based on publicly available sources. It's for educational purposes only and is not investment advice. Please, do your own due diligence before making any investment decisions. If you want to listen to our full deep dive about this topic or access more advanced contents, welcome to join Deep Value Club membership. Or subscribe to us on Apple, Spotify Podcasts channel, Deep Value Investing and deepvalues.ai.
要判断很少去。请问你之前是按照我那些是为女性呢？去按照你想问，您觉从强迫症大姐，he东西实际是放的哟。he 问问说的，he 当的冲击，这个商家也有女生的，不是能是心理家，是你欣赏大众为。
是问这个能叫